We are beginning to wonder if one of the policy mistakes here is not understanding that we're starting with interest rates at such a low base that when you quadruple them or go up tenfold, which many people think the Fed will do before all is said and done, so going from 0.25% to 2.5%. And just hearkening back to the last time the Fed was fighting inflation and ferociously fighting inflation was under Volcker in the late 70s and the early 80s. And I was there, I was just starting my career. And I remember the Fed funds rate was at 10%. Chairman Volcker at the time jacked it up to 20% in one move. So that was up 1,000 basis points, to be sure. That's a lot. And he did it to shock the economy. But that was only up twofold. We've already gone up fourfold and potentially up tenfold. And just beginning to wonder if, the impact on the economy, starting from such a low rate and having been at low rates for so long, that maybe this is, yes, a shock to the economy.
Cathie Wood believes the Federal Reserve is making a dire mistake with their monetary policy and thinks that more pain is coming for equity and crypto markets over the coming months. In a recent live stream, Cathie Wood speaks on the drastic actions of the Federal Reserve and how she believes they are crashing the market. However, it's not all doom and gloom for investors, as Cathie believes these actions are leading to muted prices that present generational investment opportunities for the savvy investor. Make sure to stick around to the end of the video where Cathie breaks down Bitcoin and the crypto market and explains to investors at what price levels she'd be buying. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
We're seeing M2 growth slowing. It peaked, I think, at about 27% and is now down to 8% on a year-over-year basis. But if you look at month to month, what you'll find is money has barely grown at all since January. That is very tight policy already. And now we're beginning, I think just yesterday, we began something called quantitative tightening. Now, I say we, it's the Fed started quantitative tightening. And what that means is that it is going to let some of the assets on its balance sheet simply roll off. It's not going to buy mortgage bonds or treasury bonds as it has been, just to replace those maturing. Many people think that quantitative tightening is a real tightening move. I think I just described the tightening moves. The quantitative tightening is nothing more than assets on the central bank's balance sheet, the Fed's balance sheet, that are going to roll off. They were kindling for what could have been an accelerated rate of bank loan growth, but they were never lit. And so they're simply going to roll off. So we don't think that is as significant as the actual tightening moves. Now, one of the fights, or the biggest fight that the Fed has on its hands, it believes, is inflation. And inflation has been much higher than we would have expected. And you know the reason. Supply chain issues for much longer, almost 2 years now, more than 2 years now. And then, of course, Russia invading Ukraine, really driving up food and energy prices. So the Fed is not happy with this, and no one's happy. In fact, inflation is a big deal this midterm election year, and it could make the difference between winning and losing. So his three answers to inflation include: let the Fed do its work. Now that's really interesting. As normally a Democratic administration would expect a little more of a dovish Fed. They'd be arguing for less restraint, but he's saying let the Fed work. And so I guess that's the Fed is an independent body, so the president shouldn't have any influence over what they do. But it is interesting in an election year to have the president saying, let the Fed do its thing, keep those interest rates going up, pull the deficit down, the government deficit down. That would be more of a Republican argument. So again, a surprise. He has suggested ways to get it down that include tax increases. We do not believe any of these will go through this year. This is a midterm election year. It's going to be very difficult to get agreement on tax increases this close to the midterm elections. In terms of the midterm elections, one of the things that is happening here is investors are beginning to think about a shift to a Republican House and maybe a Republican Senate, mostly because of how badly things have gone in this year. And one of the things we're hearing is that there will be less pressure on technology and maybe more of movement towards it. For example, telemedicine in Medicare. That's a great way to reduce costs. And so we believe that the telemedicine companies are probably going to be benefited by a shift, if there is a shift, towards Republican wins in the House and the Senate. Okay, on to the economy. Well, we've had some very interesting comments on the economy by business leaders. Just yesterday, I believe, Elon Musk said that he has a super bad feeling about the economy. And we're trying to figure out what he's looking at. We know his own sales were up. Tesla sales in the month of May, I believe, were up globally 60%, and almost every other auto manufacturer's sales were down, and some of them down by a lot. So it's not his own sales, except perhaps at the margin, maybe something that he's seeing in orders. He may be reflecting on the decline in total auto sales. And the president of Goldman described this environment as a confluence of shocks that in his career has been unprecedented. So again, he has a very good perspective, global perspective, every sector. And so I would say at the margin, these three business leaders are seeing in some form of stress. We do believe that the Fed in these next few months is going to get the message loud and clear that it cannot increase interest rates much more than it already has. We probably will see the other 50 basis points here in June, but by July, as companies are reporting earnings and talking about the future, we think the Fed will get the message. And this will be very positive for the equity markets. And this is what we're waiting for. As I always say, dark is before the dawn. We're in the bear market. We see the dollar and junk bonds and credit default swaps, all of them kind of swinging wildly in the last month, not giving us any sense of direction. We've seen commodity prices, as I mentioned, oil going back up, but not getting back to where we were when Russia invaded Ukraine. Remember, at that time, many people were expecting oil prices to go to $200 a barrel based on that supply shock, and that did not happen. This reminds me very much of 1986. Yes, I did say 1986. Oil prices were stubborn, levitating. And, you know, the cartel even had more power back then. And it levitated until it was clear that demand destruction was not going to allow for the pumping of oil at the rate. OPEC and others were pumping it. I think the same thing's going to happen now, especially now that the U.S. Or oil producers can hide behind national security as they are starting to pump more oil. I think within the next year, we'll be up to an all-time high in oil production again, and we'll be perhaps we'll be the largest producer in the world once again. I'd like to talk about Bitcoin. As I mentioned, we're launching the Bitcoin monthly. In this report, you will see that for the first time in Bitcoin's history, we've seen 9 consecutive weekly declines. And so when we first looked at that, I think the tendency was to say, uh-oh, that's really negative. My question to the team was, well, could it be oversold? Could the rubber band be stretching here? Or is there something wrong? And we don't know the answer to that, so we put that in neutral category, and you'll see we'll put each of these metrics in bullish, bearish, or neutral. Its 200-week moving average is at 22,000 and rising. Now, the reason that particular number is interesting to us is we initiated our first Bitcoin position at, back then it was the 200-week moving average. It was in the $225 to $250 range. So we've come a long way since then, but that has proven to be a nice support. A couple of other points I'll just highlight, and you can see in the report. It appears that the short-term holders, and you can see everything in this ecosystem, the transparency is amazing. It does appear, according to our metrics, that short-term holders have capitulated. That's very good news in terms of putting in a bottom. Long-term holders are at an all-time high at 65.7%. That means they've been holding Bitcoin for at least a year. We've got some very strong holders or hodlers here. That's also very good news. Although we might see some long-term holder capitulation to mark the bottom. And then the last metric that I'll feature, there are many more, is that the futures, Bitcoin futures, are selling at a discount to spot Bitcoin. During those times, we expect volatility. Now, we don't know if it's up or down, but you can see from other metrics in the piece that our thinking right now, or our judgment call, is the next big bout of volatility in Bitcoin will be to the upside. Nonetheless, we are on guard. The Terra disaster, it was a fiasco for crypto, I think, in terms of raising or giving regulators even more incentive and reason to come in and regulate a little bit more, with more of a heavy hand than we would anticipate. So take a look at the report. It will be coming out monthly. There'll be a little summary of what we think are the most important developments during the past month. And, again, Bitcoin, blockchain technology is very transparent. ARK Invest is very transparent. And we will be out there, giving you our point of view and explaining what we believe is going on every step of the way. We give our research away so you understand why we're invested, how we're invested.